The price of cryptocurrencies like Bitcoin, Ethereum, and many more have been steadily declining. Even though a change in the economy was a factor, the real reason for the drop was that crypto assets aren't worth much and need a constant flow of new buyers. Cryptocurrency is a broad term for a group of digital assets that try to act like traditional money. Since the beginning of 2017, rising demand has driven their prices, making early adopters wealthy. Thus, they are currently marketed more as an investment than money assets. However, prominent cryptocurrencies have lately seen their values plummet. Why does this happen? To fully understand what's happening, you need to know how cryptocurrencies work as financial assets. We normally do this in finance by looking at the cash flow expected from the investment down the road. To calculate the value of a company's stock, for instance, analysts project the company's earnings over the next several years. Some investments, like gold, have valued their owners even when they don't provide any income. This is because, as far back as records go, their price tends to climb in times of economic uncertainty. As a result, diversifying with them may lessen overall portfolio risk. This may make up for the lower projected return because there are few cash flows, depending on how risky investors want to be. These assets are also commodities since their owners might find some use for them even if no one else did. Cryptocurrencies stand out, but not favorably, compared to traditional financing options. Most of the time, they are worthless unless someone is prepared to pay for them. Their price seems to grow while other assets are declining, and they do not have any intrinsic value. Furthermore, the most widely used cryptocurrencies have high energy requirements. By providing new Bitcoin to the closest guesser, the proof-of-work verification method of Bitcoin incentivizes investors to employ computational power to guess a vast number repeatedly. This is expected to consume $6.5 billion in annual power costs. Since Bitcoin cannot be used to cover these electrical expenses, the system has a negative-sum outcome, meaning that the losers will end up financially worse off than the winners. In other words, the cryptocurrency market needs a steady flow of new money to keep prices where they are. All profits must come from new buyers willing to pay a higher price. The only other kind of investment where this is always true is a Ponzi or pyramid scheme, a common type of fraud in which money from late investors is used to pay an unsustainable high return to early investors. In an activity akin to Ponzi schemes known as shilling, cryptocurrencies investors actively promote the coins they possess to recruit newcomers. Taking on debt is another option for boosting the economy's ability to bring in new funds. An investor, for example, may take out a loan for $10,000 and use the collateral to acquire $10,000 in Bitcoin rather than spending $1,000 outright. This is generally known as margin trading. Because margin trading increases demand by a factor of 10, asset prices tend to go up when the market is bullish. If the borrower's investments fall below a certain level, the lender may send a margin call, which means the borrower has to sell. As a result of these forced sales, prices will decrease even more sharply. Stablecoins are another major kind of debt in the cryptocurrency market. Pegged cryptocurrencies are digital tokens whose value is tied to that of a more traditional currency, usually the US dollar. Stablecoins are released with only a portion of the money needed to cover their value in dollars. The rest of the money is invested in volatile cryptocurrencies. This is the same as a fractional reserve bank's practice of investing depositor funds differently, since only a portion of deposits are backed by cash and can be withdrawn. Liabilities incurred by this method also count as debt. As of this writing, there were 67.9 billion of the biggest stablecoin, Tether. We have yet to determine how many dollar equivalents back these assets, although they've been backed by as little as 6% in the past. For every $1 it's owed depositors, the Tether Corporation has issued almost 16 tethers. This is a big new financial obligation, and the eventual breakup of the Tether peg is generally seen as a systemic threat to the cryptocurrency industry. Stablecoins backed by a fraction of a dollar can be used to buy other cryptocurrencies, which drives up their value even if no new dollars are added to the system. More often, they are used to collateralize margin trading as described above, adding yet another layer to the debt structure. It's important to remember that the huge amount of debt doesn't change the fact that cryptocurrencies are based on a negative sum structure. A rise in leverage might put off the inevitable crash for a while, but it won't stop it and will probably make it worse when it does happen. According to the research, debt-fueled bubbles are more economically damaging than other bubbles. The current drop in the price of cryptocurrencies is a natural result of this debt-based negative sum economy coming apart. The flow of new money into the economy has stopped because interest rates are rising, living costs are rising, and things are returning to normal after a disaster. Margin traders are getting out of the market, prominent crypto enterprises are having financial issues, and stablecoins are failing due to the price decline. Other people in the crypto economy lose money because of this, and they may decide to stop paying their debts. The only way to stop this is to find a way to make more money or temporarily keep prices up by taking on more debt. Even though a change in the market was the immediate cause of the crisis, the real issue was that investing in cryptocurrencies was always risky. No one has ever shown that investments in assets with a negative value that doesn't do anything useful keep their value over time. As expected during a bubble, the promise of getting rich fast seems to have misled many people about how the economy works. Regarding the economy, policymakers need to know whether this threatens stability. Even though there is a lot of talk about how much money institutions have invested in cryptocurrency, the good news is that it is likely that the biggest and most powerful institutions will not be directly affected by the crisis. The biggest threat to financial stability is that banks may be indirectly exposed in ways they don't fully understand. During the Archegos scandal of 2021, banks and other investors lost almost $1 billion when a related investment firm went bankrupt. Unfortunately, any funds lost in cryptocurrency ventures are likely lost for good. To some extent, the Financial Services Compensation Scheme protects investors who place money with UK financial services businesses authorized by the government. In contrast, deposit insurance protects investors who keep their money in banks. But because there is no oversight in the cryptocurrency space, funds stored on cryptocurrency exchanges or investment platforms are unsafe. Individual investors may lose a lot of money, but the collapse of the crypto market is not likely to cause the next big recession. This was all for today's video. If you like this video, please hit the thumbs up icon below and subscribe to this channel. Make sure to press the bell icon to get the latest updates from this channel.